Hi, good afternoon and good evening. This is Jim Gerson from CareStack. You're in the right place. People are filing into the room right now as we speak, Andres. This is exciting. You're here tonight or this afternoon, depending on where you are, for our continuing education program presented by Andres Romero. And Andres, my apologies. My accent's terrible. I'm sorry about that. But the program tonight is entitled Year-End Key Tax Saving Strategies. And if you're here, welcome. 6 p.m. Eastern, 5 p.m. Central. Andres and Lori, I'm located in Denver, and I'm going to give a shout out to the Mountain Time Zone because we're the forgotten time zone out there. No one ever remembers us. It's 4 o'clock here and 3 o'clock in the Pacific Time Zone. Okay, so let's get started. Andres, I don't want to penalize the people that are here on time. This program this afternoon or this evening would not be possible without the generous support of Darby Dental. Darby's a great partner with CareStack and with the educational offerings that we're presenting tonight. I'm going to have Andres Romero introduce himself. And Andres, while you're doing that, if it's all right with you, just so you can guide your program tonight, I'm going to post our first poll, which is, what role are you in the dental practice, if that's okay, just so I can get a sense of who the audience is and relay that to you. Is that all right?
Sounds great, Jim.
Okay. So you go ahead and I don't want to cut you off. And I'm going to launch this here. And this is going to be in the background, but please go ahead and introduce yourself.
I'm Andres Romero. Happy to be with you. I am still happy, even though the Braves this afternoon lost 7-6 to the Phillies in the NLDS. We still are very happy. I'm very happy to be with you. It's that time of year. We're in October. There's less than a couple months left in the year, and we've been working with dentists for 20 years. Been in the business for a few more than that, but I am very excited about having you here and teaching you some great information that you can take with you and be able to use moving forward.
So Andres, let's go ahead.
Yes, go ahead.
Just tell you who your audience is for tonight, if that's okay.
Great.
So the dentists are really representing tonight. So 68% of the audience are dentists. There's no office managers, no dental assistants, and then 30% are hygienists.
Right.
And then about 2% are in the back office or in the insurance role.
Great. Thanks,
So
Jim.
thank you all for attending tonight. Great stuff.
Great. So a quick overview of what we'll be discussing today. One is, and I like to start at the beginning, is just to review what an ideal dental advisor team should look like. The role of your CPA, reviewing and kind of getting a feel on how was your business in 2022, because that is part of the conversation in terms of as we look at year-end tax planning. The importance of setting, if you have not already, your tax estimate meeting for your tax year 2022 with your CPA. And go over some of the ideas that we're going to be discussing, which include reviewing business expenses, tax loss harvesting, which has to do with investments in this very difficult investment year that is 2022. It's a silver lining of what you can do there. If you're charitably inclined, about charitable contributions, we'll be reviewing options there to help you offset your taxes. And also review your retirement plan and other strategies, including backdoor Roth IRAs, which is probably a concept you've heard about. When we talk about a dental-specific team of advisors, who are we discussing? We're discussing primarily your CPA or accountant, and if it's an accountant, please do make sure they are a CPA. It might be a consultant, whether it's on the management, tech side, systems, clinical, an attorney who reviews whether it's your corporate documents. It might be if you're bringing in an associate, if you are an associate and you need to have someone to look over your associate agreement, having a dental specific attorney is important. Your software partners like CareStack, like Darby, and on the IT side. Too many times when we work with dentists, we see that some of their, especially on the IT side, don't have dental experience. It's important that they do. Also on the banking side, whether you're looking at financing the purchase of a practice or starting up a practice or expanding your practice, having a banker who understands dentistry is really important. We talk about that a lot with our clients to make sure that they understand dentistry, because your financials and your information are a bit different than other areas of healthcare. And then lastly, having a financial planner or personal CFO, financial coach, be on your team that understands dentistry and has experience with dentistry is extremely important. So we're going to ask the question now, Jim, about the next poll to see if, do you have currently a dental specific CPA?
You got it. Let me go ahead and launch that. Thank you so much.
Sure.
Got too many windows open sometimes here.
You and me both.
Okay, so let me go ahead and relaunch a poll here. Okay, and one thing I should mention, Andres, to our participants tonight, is this is completely anonymous. So please, we love to have more vote. The more voting, the better. And that's really going to kind of guide the conversation, right, Andres?
Yes,
absolutely. How we have this. Yeah.
Yeah.
So great. So far, let's give it another about 15 or 20 seconds.
Sure.
And I'll share the results with you.
Right.
Okay, it looks like we've got everybody. 34% said yes. 46% said no. 18% not sure. And then a very small percent said, how do I find one?
Okay,
2%.
Great. Thank you for sharing the details on that, Jim. That's important. And thank you everyone for taking some time to answer that better guide you. Again, congrats to the 34% that do have dental specific CPAs. I'm sure you understand the great value that they bring to the table. And I'll be going over some of that, talking about what the role of your CPA is. Some of this may be obvious. Prepare your personal and business tax returns. Review or run your business bookkeeping. Some practices do bookkeeping, some do not. So you hire a separate bookkeeper or you have someone in your office or yourself do the bookkeeping, but they should be reviewing that on top of it. One of the things that we talk about all the time, because we review a lot of financials for dentists, is we say, hey, can I see your most recent financials? And many times when we ask that, they just print on QuickBooks a financial. And I said, no, it really needs to be reviewed by a CPA to make sure everything is properly categorized. So when we talk about financials, we talk about CPA reviewed financials, which is the balance sheet and the profit and loss reports. Some of you may get that annually. Some of you might get it on a quarterly basis. We do believe that monthly is best. That is your report card. That tells you how your practice is doing, how profitable you are, where if your expenses, if you use a dental specific CPA, if your ratios are in line, where it should be compared to other dental practices. We find that information to be vitally important to the success of your practice. And also CPAs can act as a sounding board for business opportunities and tax strategies. So that's important to be aware of. Again, as we've emphasized before, having a CPA who specializes in dentistry and has experience in working with dentists, we think is pivotal to your success, and to talk and review some of the concepts that I'll be talking to you about today. Business in 2022. Generally for our clients, we have found that most of the practices we've worked with in 2022 has been a good year for them if they have the staff to serve the patients. And that's a big if, I know, in many situations, because one of the things that we've found out from most of our practices is they're in need of staff. And some of the things we'll talk about today will have the dual benefit of not only helping you on taxes, but also helping to retain and attract top-notch employees. By having a good year in 2022, if that happens to be you, that may be translating into higher taxes. And that's why we will be talking about some of these strategies to look at. One of the things to go back to on the CPA side, sometimes clients ask us, well, shouldn't my CPA be bringing ideas to me about how to save money on taxes and to let me know what my taxes are looking like during the year? Understand, most CPAs are trained what I call to be historical, which is to take the information that you provide them, the numbers, and put it into reports and give you the reports, whether it's income taxes or whether it's your financials. Most of them are not trained to be proactive. So don't look at a CPA who is not proactive with you as not a good CPA, because in many cases, that's just the training, and why we recommend that you build that advisor team, which I reviewed with you. Business expenses. first concept in terms of potentially reducing some of your taxes. If you had a good year, have you reviewed in terms of equipment, what things you would be looking to implement either at the end of this year or beginning in 2023? A lot of technology. You may have heard of this concept before. The tax rules for most dental practices, you can take deductions on that subject to what's called Section 179 limits. And there's some details you need to be aware of. One, the maximum in 2022 that you can attribute to deduct from expenses of equipment and related technology, furnishings, etc. The limit is $1,080,000 for tax year 2022. They're subject to some additional rules, but generally that is the maximum that you're able to deduct as a business expense. Again, note, it says here non-real estate investments for your practice. Real estate does not apply for a full deduction under the Section 179. So be aware of that. Now, it's not just buying the equipment or the technology or the computers or whatever it might be and have the box in your office. It has to be placed into service. So it's got to be ready for action and not sitting in a box somewhere in your business. That's important to be aware of. And again, all of these strategies are ones that, if applicable, look at it, especially if you're thinking you're not sure if you were looking at going to get that at the end of the year or if you're looking towards the beginning of 2023. It might make sense to buy it between now and 12/31 and put it into practice. Again, financing of this doesn't necessarily affect things. Just be aware of that as well. So if you get financing, that should be fine as well. I emphasize this point. Get your 2022 tax estimates now. Make the request to your CPA if you don't already have it scheduled. She will give you a list of items that you're going to need to gather for them to give you an accurate tax estimate for the tax year. Those are going to include, obviously, year-to-date business, collections, expenses, any expenses that you're expecting by 12/31, your current investment statements. If you have a retirement plan, and we'll talk a lot more about that, in terms of what the year-to-date and planned 2022 contributions are. And if you're charitably inclined, what you've given the charity thus far and what you expect to make as contributions through the end of 2022. One example of a strategy to look at to help you save money on taxes is tax loss harvesting. And you might say, what does that mean, Andres? What that means is if you bought an investment, and this is a real example in the last 12 months, unfortunately, which has been a difficult year. You see under this example, someone who bought an exchange traded fund for $50,000 in September 15th of last year. The value on 9/28 of 2022 went from 50,000 at 409 a share to 40,000 at 332. That if you're doing the calculation, that down 18-19% might sound familiar because it's the Standard & Poor's 500 and what happened in the investment market.
Yeah, thanks for pouring salt in the wound. Appreciate it.
So, but again, the silver lining is that you are able to take some losses here to be able to manage and potentially reduce your taxes. Again, the example I'm giving you is purposefully showing you that you held the investment for more than 1 year. Right. And that becomes a long-term capital gain, which again, happy to do the math offline with you all in that regard. It's simply to say, if you sold that day, you capture a loss of $9,428, which can be deducted. Now, one of the things, if you take a loss deduction, the question is, what is the value of that deduction? And the value of the deduction is the loss times the federal and state tax rate. So if we use, just for simplicity's sake, a total of 25%, you're looking at about $2,357 deduction that you can take off your taxes after all is said and done. So that would be the value to you of that deduction. There's a couple rules, because you know the IRS loves rules, that you have to be aware of. If you sell that, you cannot buy that investment back or a like investment for 30 days to avoid what's called the wash sale rule. So that's important to be aware of. So you will want to hold off on making a similar investment for 30 days or longer. Otherwise, you're not going to capture that loss deduction. Again, for this and all the concepts that I'm talking to you, it's pivotal that you review this with your CPA. And as you've probably guessed, we partner with CPAs, talk to them every week in helping and partnering with them to help our clients. Charity. If you're charitably inclined, you have the ability also to take deductions here. Whether, in my case, I'm a big fan of Boston College, which is where I went to school, and I give them some contributions on an annual basis, preferably in years when the football team is doing better. But that's a separate story.
That's been a long streak then, right?
It's been.
When was Doug Flutie there again? Like 1984?
Yeah, before I got there, sadly. But we don't need to get into that, Jim.
Okay, we'll leave that alone.
So in charity, if you're charitably inclined, you can take deductions up to 60% of your gross income. And again, not to say that you necessarily would do that, but just be aware that that is the case. One of the things we talk about, especially if during this time, the last couple months of the year, you're thinking about making contributions and you normally make contributions, whether it's on a monthly or quarterly basis, you might want to bunch your contributions at year end, especially if you're in a year, if 2022 was good, where you are looking for more deductions. So it's important to know that these deductions need to be above the standard deduction, which did go up a few years ago. That's $12,950 if you're single, $25,900 if you're married, to make those charitable contributions impactful.
Andres, a little birdie is telling me I should launch my next poll here.
Yes.
Is that okay? How is 2022 business? Is that what you want me to post?
Yes,
yep.
please,
Okay.
Please do that. Thank you.
Thank you, little birdie. Appreciate it. You know who you are. Okay, so we love to keep our audience engaged. Please go ahead and answer this next poll. It should be posted by now. And if you want to, I'll give it another about 15, 20 seconds. Thank you guys. You're doing a great job with the responses today. Don't tell the people from the last course that we did 2 weeks ago. They were terrible. Okay, so I'm going to go ahead and hit end poll here. So the results are great. 20% or better over 2021 is 14%. Good, up 5 to 20% is 29% of the audience again. 35% is meh, about the same as 2021. And then 22% is I don't know.
Well, there you go. Great information. Thanks for the birdie to remind us about that poll.
No problem.
So other strategies that you can utilize for charity. A lot of times people say, you know, Andres, I don't want to give a ton of money to whether it's my university, my church or synagogue all this year. I'd like the ability to put money aside for charity and be able to get that deduction and make the choices later. The good news is you can do that using what's called a donor advised fund, where you can take the deduction now, you can select who the charities are going to be that receive the money later. We'll go a little bit more into that in a little bit. And then the last is you can also donate appreciated property, and that can be a great strategy, whether that's stocks, real estate, etc., so that you don't have to pay taxes on that. And we'll go through an example of that here in a moment. Other outside the box charitable planning, gifting the appreciated assets, which I just mentioned, setting up a donor advised fund. And again, the donor advised fund is one which I'll talk about in a little bit, in a little more detail, but it's basically what I call a mini trust fund slash foundation is what that's like. And the last one is limited to people. The current rule is for people 72 and higher in age, which is required minimum distributions, where you can take those distributions that are required from your retirement plan. You can give those distributions directly to charity, so you don't pay taxes on that, which is a great tax strategy, which is probably one of the most underutilized strategies for those of us who are 72 and older. Setting up a donor advised fund. Again, as I mentioned, you're front loading your charitable gifts. So where you want to get a big deduction, but you don't want to necessarily give all of the money right now to the charities that you have in mind, or you're not quite sure which ones you might want to give it to. The advantage with the donor advised fund is the money goes into the donor advised fund, and then you get the charitable deduction now and can decide later which charities are going to benefit from that. Again, typically, I call it a mini foundation. In Atlanta, we have some of the Home Depot founders, Arthur Blank being one of those, who owns the Falcons and Atlanta United. He has a big foundation, but this is a version that you can set up for as little as $10,000 to $25,000 and be able to take some deductions, again, if you are charitably inclined. I want to walk you through gifting appreciated assets, because I've noticed a lot of people don't do this, and they should. This example, the first, we're going to talk about donating an appreciated security. So it could be a stock, exchange traded fund, a mutual fund, a bond. Let's say it's worth $10,000. If you were going to cash that out and then give it, you would pay ordinary income on that of $3,500. And the capital gains, you're not going to pay, because you're going to take the appreciated security and give it directly to charity. You save that $1,200. So in essence, you get the benefit of the deduction, which is the ordinary income tax savings, and you get the benefit of not paying the capital gains. Oh, 1 second here. There we go. I'm sorry for that. There we go. The net savings there is $4,700. And in comparison, if you donate $10,000 in cash, you get the $3,500 benefit, but you get no capital gains benefit that you're not paying. So the net tax savings is $3,500. And the last, which we would recommend you not do, is if you sell the security and donate it, you get to save the $3,500 on your taxes, but instead of saving, you pay the capital gains tax. So your net savings is $2,300. So key here, by doing the appreciated asset versus donating security and selling the security and donating cash, you see a $2,400 difference in terms of minimizing your taxes. Again, this is why it's important to review these strategies with your CPA and with your financial team.
Andres, can you leave this slide up for a moment? Can you go back to that
Sure.
for 1 second?
Sure.
We're getting a lot of questions in the Q&A, and this is great. Please ask
Sure.
questions. We're going to have time at the end. But people are asking about, they want access to the slides. At the end of the presentation, Andres is going to have his contact information. And the best way for you to, if you want slides or you want to dialogue with him, is to contact him directly and have kind of a one-off exchange. Okay. So at the end, we'll make sure to have Andres's contact information for you.
Yep. And there'll be a QR code where they can click, and we'll have a checklist for them, and they can reach out to us, and we're happy to share information with them.
Okay, great. Thank you.
Yep, sure. Retirement plans. Typically, people hear about a 401k plan. If you have one, please make sure that you're contributing the maximum. In 2022, that's $20,500. If you happen to be blessed and be over the age of 50, you can put in another $6,500 for a total of $27,000 into the 401k. You can, in addition, This is on the 401k, this is employee money. So it's a deferral. In addition to that, you could do a profit sharing contribution. That is employer. We always summarize employee and employer by EE and ER. So you as a business owner, if you've had a good year and you want to share in the good year and also get a tax deduction, you can make a profit sharing contribution that can vary in amounts, typically up to anywhere in the realm of $40,000 to $50,000 per employee, if you so desired to give that much. And
Andres, your pen and your telestrator is like a blend of Jim Cramer and John Madden. You know, I like it.
Well, if you want, we'll dissect some of the plays from the Chiefs Raider game last night. And then if you have a very profitable practice and you want to do beyond just level 1 and 2, you can add what's called the cash balance plan. And really, it's kind of like a mini pension. We have had practices historically that have done that and really shared the success of the practice with their staff. It can make sense. And again, all of that is also deductible from your taxes. The benefits of an effective 401k plan, and we'll give you a comparison about different types of 401k plan design. One is maximize the tax deductions for the dental practice for you, the dentists who own a practice. Maximize tax deferred retirement savings, not only for the dentist, but also for the employees. Again, an effective plan, you're going to minimize startup costs and maintenance costs because you do have both in a 401k plan. And this has become an extremely important point in retirement plans. We are talking about year-end tax savings, but if you can kill a few more birds with one stone, the recruitment and retention value to having a 401k plan. I don't know if any of you saw the Dental Post annual survey. Retirement plan benefits were top 2 and most requested benefits by employees of dental practices. And having a good one makes a difference. And it is about having a retirement plan where employees have good investment choices and can defer their income, and the owner is going to put also some money aside, but it's also good technology. All the 401k plans that we put in place for our clients, we make sure there's great tech where they can go to a website or an app to not only look at their balances and their funds, but also have the ability to do some basic planning for themselves and for their family. We find that extremely important. Here's an example of, and this is an actual example of a retirement plan, that a 401k plan design that we encountered. The first is what they had, a salary proportional allocation. I'm not going to spend too much time on it, just simply to say it's about 18% of everyone's pay. And this is the employer money that was put in, the profit sharing plan. And you see here that the contribution, 19% adds up to $97,000. One of the things that we look in the analysis is, hold on one sec. Sometimes my telestrator gets a little worked up. Let's go and back here. One of the things that we look at is what percent of the benefit goes to the owner. So this in relation to this. So again, good tax savings there under this example. But if you want to have a more effective plan where not only you benefit the employees and the staff, but also the doctor, you can look at different allocations. And I will tell you, we come across 401k plans every week that you just signed up because your payroll company offered it, and there's no time spent on developing an analysis of what allocation is best. In this example, the dentist got more of a contribution. The total net contribution was $66,000, and we're able to direct 80% plus to the doctor. So it's a different type of effective design strategy that you can utilize and is available under current tax law by the IRS. You just have to know that the different designs are available to help you and your practice. Retirement plans come in many flavors. The example I just went through with you is a 401k profit sharing plan, which is a standard 401k with the profit sharing. You may hear the term safe harbor. That means that you are giving a minimum mandatory contribution to your employees. Typically, that number is 3 to 4% of their pay. And the IRS gives you that option so that you as a doctor, meaning the doctor owner, is not limited in the employee contributions, deferrals that they can make. And we highly recommend all our practices utilize a safe harbor contribution. But you might say, hey, Andres, I might not be quite ready for that. You have the ability to look at various different profit sharing plan options. Also new comparability, which is the example, the recommended example under that last illustration I showed you. 401k new comparability, which combines different strategies of both the 401k deferral along with profit sharing. And if you say, hey, I'm not quite ready, we also have what I call retirement plans on training wheels. So you can start with a simple IRA or a simple 401k plan. In those, instead of the 20,500 maximum, simples have a maximum of 14,000 if you're under the age of 50 and can put in $3,000 more if you're 50 and over. So that could be a good starting point. And again, if things are going really well, you can implement a traditional defined benefit plan. In my 20 years working with dentists, I've only come across a couple of those, but if it fits, that might be worth doing. The other option, cash balance, we do see more often for very profitable, successful practices. And again, it's a combination of benefit along with reducing taxes. Some of the most overlooked 401k plan strategies that we've seen, and these are all actual examples we come across probably at least every month. One is adding a spouse to payroll. So one question we typically ask when we're talking to our dentists, I say, hey, doc, does your husband help in the practice? Like, oh yeah, he helps me with this and this. And we say, do you pay them a salary? And they're like, no, I never thought of that. So we get together with the CPA, pay a salary, and we have that full salary go to a deferral in a 401k plan. It's a great, very overlooked benefit that you can utilize to put into your 401k plan. Add the safe harbor profit sharing. Again, we're doing this to allow, and again, as I mentioned, this is 3 to 4% contribution. And what it does is it allows you to max your deferrals into a plan. So if you have ever had a 401k plan say you got to give money, we got to take money from the deferrals and give it back to you, and you get taxed on it, you need to have your 401k plan reviewed immediately, because that should not happen in an effective 401k plan. Add a Roth 401k option. I talk about this with prospects and clients quite often, and they say, oh, Andres, I'm not eligible for a Roth IRA. I said, no, I'm not saying a Roth IRA. I'm saying a Roth 401k. All your plan documents need to allow for a Roth option. A Roth 401k allows you to decide if you want to put your money in to the Roth side where you don't get a tax benefit now, but you get a tax benefit long-term. And you're able to pull out money from the Roth 401k on and this is a magical phrase, tax-free basis. Okay. That is the best way to go about doing part of your 401k plan. And then where applicable, adding cash balance pension, again, for more profitable practices that they're looking to set aside more money into a retirement plan and take more of a tax deduction. Other tax planning ideas to take into account, adding your kids to payroll and fund a Roth IRA. Again, these are all concepts that we recommend you have reviewed by a CPA. We have lots of practices where they include their kids on the office brochure, the website. If your CPA thinks it's okay, you can add the kids to payroll and take that money and fund a Roth IRA for them, because Roth IRA has to be funded with earned income. A Roth conversion. So something that's talked about a lot in terms of taking your existing either IRAs or 401k money and converting it to a Roth. That's a concept where we could have a separate webinar just on that concept. but it's something to consider, and we're happy to review that with you if you'd like to do so.
Andres, I think we're ready
yes.
for our next.
Yes, let's. I did not forget, Jim. So
okay,
go ahead if you want to post
I need
it.
these
Go
kind
ahead.
of reminders in life.
Yeah.
You know, okay.
Go ahead.
So, and I apologize. The field was truncated. The question is, do you have your 2022 tax estimates from your CPA? Not CP, but CPA. And we'll give it another. We got someone raise their hand, which I love raising their hands. Yes. But I'm not good at Zoom and about to unmute your line. So if you've got a question, do us a favor, throw it in Q&A. And we'll answer it. So, okay, I'm gonna end the poll here. So 57% said no. 17% said, Andres, I'm calling them after this meeting.
Good.
Regardless of what the time zone is.
Yes.
11% said it's scheduled. And for a gold star, 15% said yes.
Fantastic. Well, it sounds like most people are at the right place in this meeting. So we're coming up to the end now. The backdoor Roth IRA, I wanted to talk about just for a moment before we go. But this is the idea where you put money into a traditional IRA and then you go ahead and do a conversion. The reason you look at doing this is because a regular Roth IRA contribution has income limits that most people are not eligible for contributing money into a Roth IRA. Most dentists that we come across are not eligible for a Roth IRA. So from that standpoint, the backdoor Roth IRA through a conversions currently do not have any income limits. And notice I said currently because tax legislation, things change all the time. As of right now, Roth conversions do not have income limits. So funding a non-deductible regular IRA and then converting that over to a Roth IRA is allowed without any income limits currently in 2022. So we've given you a lot of good information here, but I want to make sure that you take action on this. And as I wrap up, I want you to write down what are your action steps going to be. So one, and again, this seems to be applicable to many of you, set up that appointment with your dental specific CPA and get your tax estimate. That's the start. Again, consult with your dental specific financial coach, CFP, and your CPA to review possible strategies that you can use. Again, having both of them work together is the magic in making sure that you do all that you can to properly save money on your taxes and also build a long-term plan in terms of achieving your financial goals. We think that is pivotal. And then pick those strategies and take action. And it is very important that those strategies that either your financial coach, CFP, gives you are reviewed by your CPA. Your CPA needs to give the okay, because if God forbid the IRS come knocking with an audit, it's going to be your CPA who's going to protect you and going to work on that side. And again, and none of the strategies we've talked about are that extreme where it might be subject to an audit. But again, having that team is going to be pivotal. And once you take action, make sure if you haven't already, if you have a 401k plan, get it reviewed. If you don't have one and want to implement one, it is not too late to do so for 2022. Reach out and look at implementing one if it makes sense for you. Thank you everyone for this. If you'd like, you can scan the QR code. We're happy to give you a checklist on some of the concepts that we talked about, and you also have access to our information. Jim, I'm going to turn it over to you for if there's some Q&A.
Yeah, we have some questions, and I'm going to go ahead and pose them to you.
Great.
We intentionally left about 10 minutes to answer questions, so I'm glad some are coming through. Do us a favor. There's like a great turnout tonight. Get off your hands, pose your questions to Andres. This is the time to do it. Don't email me or Dan Hall tomorrow and ask us what we think of a 401 Roth, right? We have no, Dan, I don't have any idea, right, Dan? Like, I don't think we even have a very good 401k here at CareStack.
Yeah, agree, Jim. I wouldn't be able to field those questions.
So
leave it to the professional.
So let me go with the first question, Andres, and then I want to continue to go back and answer these as they come up.
Sure.
All right. So this is a question on equipment from this practice. Can I take a deduction on equipment if I finance it?
Yes, you can. So the financing will not affect the ability to take a deduction. So it will be a deduction for the amount of the price of the equipment that you put into practice in the practice by 12/31 of 2022.
Okay, I like this question because I find myself always asking this. And this is from a practice owner. You know, if there's one nugget or one pearl I take away and I implement tomorrow, what would you recommend that is in my business related to the program tonight?
I would say the number one thing is if you have a 401k plan and it has not been reviewed in the last couple of years, have it reviewed. If you don't have a retirement plan like a 401k, look at implementing one. Because again, it's going to kill two birds or multiple birds with one stone from the standpoint that it's a good benefit. It can help you on your taxes. And in 2022, the number one issue that dentists tell me that they have is hiring and retaining staff. And it's already been proven by the Dental Post survey this past year that a retirement benefit is one of the top benefits that is important to dental staffs.
Thank you for speaking to that. Okay, another contribution here from the audience. What tips and suggestions do you have as I switch from a W-2 to 1099 related to an S Corp or LLC?
Fantastic question. So congrats to that person who's switching from a W-2 to a 1099. Your tax saving strategies have just expanded by a multiple of 10. So you have a lot of options to reduce your taxes. I would say number one, get a good dental specific CPA. Number two, look for a financial coach to help not only with the strategies, but also for the ongoing coaching if you're either an associate or a hygienist or and you're working at different places to make sure as the money comes in, you know how to properly allocate it, not only for your financial needs, but also for your goals.
Okay. What do you most consistently see as like a common kind of misstep by practice owners when you speak nationally or you're out kind of in the different locales that you work with? Is there a consistent thread of a kind of like a pitfall that trips people up?
Yeah, I know I keep going back to the 401k plan, but that is the number one thing where in most cases 401k plans were implemented because their payroll rep said, hey, would you like one of them this year 401k plans? And there was no foresight or analysis done to see which type of structure of a 401k plan was best suited for that practice at that time.
Good stuff. Andres, the questions are coming rapid fire, which I love.
Great.
What are some financial milestones an owner doctor's practice should meet before initiating a retirement plan for their employees?
Great question. And I actually have a video about this topic as well. But I would say the number one thing is profitability. So I recommend, again, if you're getting your monthly financials on your profit and loss, you need to make sure that you're profitable and preferably before owner's compensation. So profit before owner's compensation, we want that number to be a minimum of about 25 to 30%. If that is the case, you're a good candidate to implement a 401k or a retirement plan.
Okay. I have one more question here, and then I'm going to do an auction, going once, going twice, and then it's going to be it on the questions.
Right.
How do I know if maybe this kind of dovetails in the last one, but how do I know if my practice is ready for a retirement plan?
Again, same thing. Make sure that number one, you have current profit and loss, meaning in the last couple of months, so you can see where your business is. And if that is the case, you look, it should be towards the bottom of the first page of your profit and loss statement where it should say profit before owner's compensation, and look at what that ratio is. You want that to be in the 20 to 30% plus range.
Great stuff. Okay, so any more questions from the audience? This is your chance to do it. I don't mind a little bit of golden
great questions.
Silence. Yeah,
way,
it's great
for everyone.
It's great that they're coming.
Yeah.
I mean, you've done an amazing job keeping everyone here to the bitter end. So thank you. The
Sure.
best way, Andres, for people to reach out to you, email, phone call, what do you prefer? What?
Email is great. You can call us. That number, by the way, can also be texted that we have there, that 678 number. If someone wants to text us there, we can follow up with you, and we're happy to schedule a complimentary initial meeting.
And then definitely scan the QR code for the checklist and to get engaged with Andres and the team. Again, if you want to learn about our future courses, please join the CareStack Champions Facebook group. A big thank you to Andres for a tremendous program tonight. And we hope to see you in our next course.
Great. Thank you, Jim, Dan, and to
Andres,
Lori from earlier.
nice to meet you.
Yeah, good to meet you all. And let's go Braves.
All right. Good luck. Have a good evening,
Bye.
everybody. Take care.
Bye-bye.
Thanks, everybody. Bye-bye.